Hey, Ron Yarbrough here. Ron Yarbrough here. I'm just wanting to give a quick explanation on what is a 3-2-1 temporary buy down, so that people can be more informed of what that is. It's not a program where you can actually buy down your interest rate forever. It gives you an opportunity to get into to a home with a much lower payment. And refinance in another year, 2 years when rates come down, to save you a bunch of money on your payment. So a temporary buy down, there's several different ways to phrase them, but they're commonly a 3-2-1, a 2-1, and a 1-0 buy down. A permanent buy down is something that somebody would pay points, discount points, several points sometimes, to buy their rate down for the life of the loan. But a temporary buy down is just a temporary buy down up to 3 years. So a temporary buy down is essentially to put interest into an escrow account to help subsidize the payment for a period of 1, 2, or 3 years. The interest is held in an account until the whole amount is used up. The 3-2-1 buy down starts the payment based on a 3% lower interest rate for the first year and 2% lower for the second year and 1% lower for the third year. And then the remaining 27 years will be at the same payment. A 2-1 buy down refers to a 2-year period. So it's 2% lower the first year and then 1% lower the second year. A 1-0 means basically the first year is 1% lower. And that lower percentage is just the payment itself. So a permanent buy down would be, I got some old information in here about loan amounts or whatever, but a permanent buy down would be paying a large discount fee to buy down the rate for a longer period of time. So an example of a 3-2-1 buy down would be on a $300,000 home with a seller builder paying a 3-2-1 buy down fee based upon today's rate. A buyer is offering to purchase a $300,000 home at full price and is going with a 0 down USDA loan for a primary residence. The buyer has perfect credit and can qualify based upon the full payment of the mortgage. So purchase price is $300,000, down payment is 0, loan amount is $300,000, full rate would be 7.75%. So the full payment would be $2170.73 for the principal and interest. The first year payment would be $1580.59. The second year $1768.23. Third year $1965.25, and the remaining term would be $2170.73. The total cost of that buy down for this scenario would be a total of $14,235.06. And that fund is funded by the seller. It cannot be funded by the buyer. It can be funded by the seller. It can be funded by the realtor or somebody else, but it cannot be funded by the buyer. So taking a look at the total numbers, that I just the estimated taxes and insurance also into the payment. So the first year payment on a USDA loan in Camden County, Missouri, is going to be somewhere with taxes and interest somewhere close to $1964.98. If you look at the monthly payment difference, the difference for the first year is a substantial amount of money. It's $590.40 savings on that first year payment. If rates were to drop during that first year, they could refinance at the lower rate, and the remaining funds in that escrow account would be applied to the principal balance. And I'll show you those numbers in just a minute. So the benefits for the seller would give them a way to offer up a sales price reduction, to not offer a sales price reduction to motivate a buyer that's just sitting on the fence. And if they're sitting on the fence due to the high payment, but they can still get approved for that fully amortized payment, it gives them an opportunity to get in there with a much lower rate and if they refinance in a year, get the rest of that money to apply to their principal balance. To the buyer, they get a much more affordable payment and can apply any unused funds to the interest account to pay off when the rates go down for refinance in the next 12 months, 24 months, or even 36 months. There'll still be money left in that account. The buyer can protect their price of the home as homes continue to go up in price, because when rates start coming down, the inflation of purchase price will probably happen again just due to the supply and demand of homes. Sellers will protect their value by not discounting their value to get a home sold quicker, and it doesn't offer as much savings by lowering the price as it does by doing a buy down. So if you want to look at a way to calculate some of these numbers, we can take a look at a temporary buy down cost calculator. So a total loan amount of $300,000 at an interest rate of 7.75%. Loan terms 3 years on a 3-2-1 buy down. The first year cost would be $7,011.54. The second year cost would be $47.8222. The third year is $24.4131. Gives you a total buy down cost of $14,235.06. Now, if they were to refinance after 6 months, the principal reduction on their loan would be $10,729.30. If you didn't count for the actual amortization of that loan for those 6 months and paid off based upon the original amount of the loan, that would give them an estimated payoff of $289,270. So I'm hoping that this explains a little bit to you to help you be able to inform your buyers, and also hopefully be able to help your sellers as well. So if you have any more questions, I would love to help you out, and look forward to answering any of your questions. Thanks. Bye.